welcome to the Fred Report Technical Market Conference Call for February 17th, 2011. I want to wish everybody a happy expiration week and also a happy President's Day weekend. Let's get right into the meat of the call. I understand there's a couple of people getting ready to leave on vacations for the weekend, so this will be a little bit quicker a call probably. First of all, stocks are trading up about as we expected for expiration. You know, we're up a little bit and we've started to go choppy. My guess is today will be down, tomorrow may be up, but we'll probably end up closing options expiration week around here. In terms of intermediate term stuff, we had a number of questions from people about the sector report, so we will address those here. The first question is, should we sell XLE Energy? The answer to that is, to me at least, the seasonals are suggesting that XLE and OIH are getting ready to come down, but the Middle Eastern stuff is still such that I'm not so sure that's the case. What I would consider doing is selling some of your XLE and perhaps putting it into Staples, which is XLP, with the idea being that's a little bit of a defensive switch. We note that Staples are trading right now at an all-time high versus the all-time high close last in 2007 of 29.17. So Staples have performed reasonably well. In fact, they have performed better than energy overall. And my feeling is you may get a phenomenon known as right translation in cycles parlance, which means basically even if something's very strong, if it's going to correct seasonally, it will correct seasonally into the time frame, which in this case is May, but it has a tendency to hang up for a while and then drop more sharply. So that's sort of what we're looking at for energy. Staples would be a little bit better a bet for some of that money, but energy is probably going to be strong in the second half of the year. If we're right, the second half of the year is going to be better than the first half of the year for stocks. And what that suggests to me is that energy is going to be a leader, and as we said before on other calls, we're going to see some more inflation, and that's going to be good for energy as well. Now, the other question we've had is, should we sell technology? We use the IYW for that. Tech has obviously been one of the strongest sectors. We were overweighted for 2 years. We dropped the overweighting back to an underweight and then to an equal weight. We note that the only real problem we have with technology is that everybody is in it. It's an overweight for 7 out of 8 of the chief investment strategists on Wall Street. If something were to happen with technology, the selling would be very quick and very alarming. So again, you might want to move some technology into either materials, which is one of our overweights, which most people are not overweight, or industrials, and realize that if we do have a stronger economy going into the second part of the year, we're going to see materials and industrials do at least as well as technology, and perhaps better. That's an area that we do like to be in. So that's sort of guideline. I kind of wish in a way I'd stayed with the upgrade on technology because it has worked, but you never get out of these things, you know, at the exact peak, and I'm concerned that it will come down a bit, especially Apple if we get any more Steve Jobs news that's bad or something like that. Plus, I've heard from portfolio managers a lot of people are slowly selling Apple off to get to an equal weight. We don't have that as one of our more favorite stocks, but the stocks in that are up. They're ripe for a correction if we get something. And we're expecting a possible pullback after the first part of March. In other words, strong into the end of February and then a possible pullback. Monthly, weekly, and daily indicators would be overbought under those circumstances. If we're going to get a little bit of a pullback, that would be the way we do it. Bonds are right up at resistance. We've had some questions on bonds. Much through 91, they've got a target of 92 and then 94 on the TLT. The accumulation model on bonds is still pretty strong, and that suggests to me that bond investors want to be accumulating bonds for their clients, but there may not be a trade here. This is, I think, a bear market, and what happens in these bear markets is when you get a move, it's very quick and very violent. It's not a long uptrend, so it's much harder to play. We tried to play it once, did not work, and we're going to sort of stand aside there, but I do think this is probably in the area where rates are going to close for the year, so you probably won't lose anything by buying bonds here, and we may get a capital gain opportunity down the road. We've been asked some questions about oil, which has come down even though oil stocks have not. The USO came down very near to our price at 35. We can certainly nibble at oil on the USO under 36, which is where we are now. I would expect a summer rally in oil, sort of consolidation, but that summer rally on the USO could take us back to 42 to 44. That would be a very nice trade, and that's an area I'm really, really interested in. That could be much stronger this summer than people expect. Gold has rallied rather sharply off of the 128 area. Remember, we've been saying to buy it under 130 as a nibble with the idea that it's going to start to really go up in May. Short-term resistance on the GLD is now 136. Then we think it can turn back down again. Should that occur, we will be more interested in buying it below 130, and we think that gold could have a nice, strong summer rally as well. Commodities tend to do well in the summer. Stock questions, we'll go into those. First of all, Amazon